Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 7th of August. I'm Daniel Lam, your host for the podcast. We have seen some very exacerbated market moves. So for example, on Monday, Japan equities were down 12% and S&P 500 dropping by another 3% in one single day. And of course, there has been some very sharp short covering in the yen against the dollar. Now, to me, what happened was yet another classic domino effect, which can happen whenever there was a significant, or in this case, several significant pieces of new information for investors to be reacting to. It started off last week with the Bank of Japan sending a very clear signal to defend their currency, leading to short covering in the yen against the dollar. Now, many investors do borrow the yen due to its low cost in funding and use the proceeds to buy risky assets, which includes equities. And then bam, came the weak US job numbers, which led to fears of sharper than expected slowdown in the US economy and concerns that the Fed has been being too tight for too long. So suddenly the markets were not debating whether the Fed would be cutting in September or not. The discussion quickly moves to how many cuts there will be for the rest of the year. And this is close to 5 cuts by what the money market is implying. So this sudden recalibration of rate cut expectations led to a sharp rotation of funds from equities into bonds, and the selling in equities were also exacerbated by the forced unwind of the dollar-yen carry trades. And of course, for the trend-following quantitative CTA funds, they would need to be unwinding as well, given stop losses have been hit. So what to expect from here? Well, from what you could tell, there is going to be a lot of positioning and technically driven flows over the next few weeks, and volatility is likely to persist in the month of August. The positioning unwind is not finished yet, and therefore we can expect strong showing in DM government bonds and gold in the very near term. And the return of negative correlation between bonds and equities show yet again how important it is to have a diversified portfolio allocation. We do believe that with the Fed funds rate at a 23-year high, the Fed has significant capacity to ease policy and to help the US economy achieve a soft landing. US large corporate earnings and balance sheets remain healthy. And this sell-off has also provided more attractive opportunities to be scaling into, such as the growth areas in equities. This is something that we've been discussing in the podcast over the last 2 weeks. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.